All right, Fed meeting at the end of the month. Not all these government numbers coming out. You could always look at the markets. Joining us now is E.J. Antoni, Heritage Foundation Chief Economist, and Doug Holtz-Eakin, American Action Forum President, former CBO Director. Gentlemen, welcome. So, Doug, I'll go to you first, because this is kind of fun. So they're not, all right, we're not getting the releases. There might be a CPI before the meeting. Maybe not. I don't know. But, you know, how about markets? I'm looking at all these markets. These are inflation markets, okay? The 10-year bond is now dropped under 4%. The Goldman Sachs and CRB commodity indexes, Dougie, as you know, basically flat year to date. The five-year forwards, the CPI break-evens that Steve Myron talks about, 2.3 in that vicinity, haven't moved much at all. Oil prices coming down. West Texas under $60. Now, I know gold has exploded, but that's because China and their friends are trying to bring down the dollar. They're the ones buying gold. I don't think gold thing has anything to do with inflation. So if I were the Fed, I'd look at these market indicators and cut rates, Doug. What would Doug Holtz-Eakin do?
Well, I think we'd be on track for a 25 basis point cut, Larry. I do. You know, we've got some residual inflation in the last reports that we saw. CPI was about 3. Personal consumption price index a little bit below that. I'd like to see those numbers at 2. And we also have a labor market that is clearly softened, and there's no doubt about that. We don't have the most recent data, but if you look at, for example, the ISMs, the supply managers indices, or if you look at the Fed, Empire State or Philly Fed, they show some softness. There's no question about it. So, you know, in this environment, you want to worry about the employment mandate. That means cut. You want to evaluate your options. And that means don't cut aggressively. We're not in break the glass territory. So I think we go 25 basis points and look around.
E.J. Antoni, get your take on the same thing. And let me just add, Steve Myron, you know, whatever he is, CA chair and temporary Fed board member, he's got a thesis, though. Rental prices, which is a big part of the CPI, rental's going to come down because you've had all these self-deportations and so forth that were driving up inadequate housing supply, so rental rates were too high. He says rental prices are going to come down, and on top of other supply-side activities that will reduce inflation, and therefore the Fed ought to go 50 basis points, EJ. What do you think?
Well, Larry, it absolutely amazes me the number of people on the left who are saying, ironically, the exact opposite. They think that somehow getting illegal aliens out of the country is going to be inflationary. Please explain to me then how bringing tens of millions of them in was not disinflationary. That should have been bringing down prices if getting them out is somehow going to cause prices to go up. So that, I mean, that whole argument from the left is just absolute nonsense. But getting back to your question, Larry, on the Fed, what they should be doing, I'm still a firm believer they shouldn't be trying to lead markets around by the nose. They should be following markets. They shouldn't even be trying to set rates the way that they are. Instead, they should be reducing the balance sheet much more quickly than they are. And they do that by stop paying banks not to lend money. Yes, you're going to reduce liquidity in theory by selling off a large portion of the balance sheet. But again, if you stop paying banks to lend to the Fed, they'll lend to the market. They'll lend to the Treasury. That'll bring down interest rates on things like your mortgage. It'll bring down interest rates on things like treasuries. Yes, I understand it's ending the gravy train for Wall Street, but I'm sorry, it's about time we did that.
You know, it's interesting, Doug. I'm looking at the 10-year, and, you know, Scott Bessent was talking about the 10-year. So basically, year to date, or, you know, since Mr. Trump has been in office, the 10-year's dropped almost a percentage point. In round numbers, Dougie, 5 to 4. All right, so it dropped below 4% today, which is interesting. So a lot of people use that. I mean, when I was on Wall Street, a lot of people use that as a gauge. That's the long rate is leading the short rate, and the Fed should follow the long rate. I mean, that's an interesting hypothesis. So the Fed has dropped them 25, but the long rates come down 100 basis points. Seems like there's a lot more room for the Fed to let that funds rate drift lower.
Yeah, I think the counter argument, Larry, is that, you know, a year ago when they cut 100 basis points, the long rate went up 100 basis points. And so their ability to rely on that, I think, is fairly limited at the moment. And, you know, I think the Fed has really, you know, been a little slow to recognize the weakness in the labor market. It was Governor Waller who I think first pointed out it was a lot worse than the numbers seem to indicate. He's still at 25 basis points, so cautious people who understand the employment mandate are landing there. That seems to me the right place to be.
EJ, we don't have much time, just 30 seconds. I can't wait for a whole new management at the Fed. I want a whole new sweeping management. I want new models. I'm with you. I want them to shrink the balance sheet, the monetary base. I want new Reserve Bank presidents. I want new deregulation. I want new. It's time for the change at the Fed, EJ. Go ahead, take a whack at that one. I've dished it up very nice. I've laid it in very nicely for you here. 25 seconds, EJ Antoni. Go.
Larry, these are the people that gave us 40-year high inflation, the most volatile interest rates in over 4 decades. They gave us a regional banking crisis in the spring of 2023. My goodness, if you look at some of those regional bank stocks today, you might think we're in for a repeat. They have destroyed and completely frozen over the housing market. I agree. Just fire the entire board at this point, and I would say Kevin Warsh is probably the best person to head up the Fed come May.
All right. I'm for Doug Holtz-Eakin myself. Gives good advice. You always give great advice, Dougie. Anyway, EJ Antoni, so do you. Thanks to both of you. I appreciate it very much.